I'm Darius McDermott from Fund Caliber, and today I'm delighted to be joined by Laura Bottega from Morgan Stanley Global Brands. Good afternoon, Laura.
Hi.
So look, maybe one of the most telegraphed recessions in history. Normally they creep up on you, but this one looks fairly well telegraphed. Even if we don't end a technical recession, economies are slowing, cost of living crisis. Why do we think a brands type portfolio can do well in this environment?
That's a great question. It's worth remembering, of course, that companies with brands are just a part of our portfolio. Global Brands is shorthand for companies with strong intangible assets, high returns on capital, fat gross margins, strong free cash flows, all these good characteristics. And we believe they can be found in consumer brands, but we also find them in healthcare and software. We're looking for the complete package, high quality companies with high quality management at the right price. In the consumer space, to your point about the deteriorating macro environment, we're really particular about the categories we're exposed to. So we choose companies which demonstrate pricing power and recurring revenues. And these superpowers means that both margins and revenues are robust in a downturn, supporting profits. So we look for companies where the consumer is comfortable to keep paying because the product is mission critical. Think software that keeps your business going, or needles and syringes in a hospital environment. Spaces that are becoming more personalized, like beauty or diagnostics. Sectors where price is no object, like pet care. So what's really interesting is that the combination of the pandemic and then the supply chain issues pushed us into a world of excess demand, where many companies look as if they have pricing power, given their shortages of product. But as supply chains improve, as things normalize, and we return to a world of excess supply, we believe more commoditized industries' lack of pricing power is likely to be revealed. And then you see an earnings and performance gap between quality and the rest of the market.
So sticking with the brands theme, if we like, a lot of brands that are household names are well established, old companies that have built these moats and barriers to entry over multiple decades, and they're global, obviously tend to be rather than local companies. As the world's sort of dynamics are changing, are you finding that there are challenger brands that either come to threaten established brands or are on the journey, I suppose, to becoming more established brands? And if that's the case, how would you expect the fund to adapt?
Of course, that's an ongoing dynamic. But I think the notion of disruption by smaller challenger brands felt more of a threat a few years ago, when challenger brands first began using social media to gain market share. But as the larger established brands have put real resource into digital, their scale and breadth has really come to the fore, allowing them to continue to dominate. They can also fairly easily acquire challenger brands and offer them better distribution or resources within a larger ecosystem. Beauty is a good example, where your Instagram feed, maybe not yours, may suggest a host of smaller new companies trying to gain traction. But the reality of global distribution and steady supply, continuous marketing is much harder than it looks and more easily handled by established brands. Of course, younger generation, the next generation do seek out different brands to their parents. Some revert back to the brands favored by their grandparents. We look for diversified, decentralized companies that are agile in incremental innovation and that will appeal to the consumer and allow the company to keep charging a premium for that novelty. And generally, we're not trying to hop onto the next fad, but we like the established brands that have the global resource and diversified product set to navigate changing tastes.
So a number of well-known brands have taken a step recently to ditch their wholesale distributors, preferring to deal with consumer directly. Why is that happening? Because often platforms, those intermediaries have been good businesses with good brands. And are you seeing this within some of the holdings in your fund?
Yes. And of course, the answer is really great brands want to stay in control of their brands. And the best brands are really tightly controlled. We've seen this direct-to-consumer trend most particularly in sporting goods. Going D2C bypasses the wholesaler, the retailer. It bypasses distribution cost. It bypasses the risk that the distributor doesn't display or price or market the product the way the brand would prefer. A further factor we think is technology and the advance of digital analytics and social, which allows companies now to better metrics about the consumer, which is then used in future product design. And I think these companies are also looking for a more direct and personalized relationship with the consumer. So
a tougher year, 2022, for quality companies, of which I think you're describing and attributing to your Global Brands Fund. What's your outlook today as we're sort of sitting here, in the early part of 2023? Do you see much more value, or are you seeing that these strong companies, having been quite resilient, even dependent on their share, not dependent on their share prices, which obviously are a function of stock markets?
Yeah, I would have to reiterate that we see a continuing fairly tough environment for companies going forward. Generally, higher input costs put pressure on margins.
Yeah.
Supply chains need investing. They want to be as modern and flexible and local today as they need to be in a more polarized world. The interest rate environment, whether it's 25 bips up or down, the point is more that this higher level of rates creates more pressure for indebted companies. And that's exactly why we focus on the companies we do. High quality companies, more resilient earnings that are more likely to survive and thrive through the cycle. Some of these are brands you would recognize as a consumer, but some are brands that dominate business to business, such as software or cloud companies or credit card companies. Where we find potential earnings resilience today is in the subset of quality and software, medtech, and staples, particularly. We believe that adding earnings resilience to your portfolio gives investors more predictability in the top and the bottom line, and a peace of mind that only comes from owning quality.
Laura, thank you very much. For more information on the Morgan Stanley Global Brands Fund, please do visit fundcalibre.com.